There are no rules. How many stocks should you have? Is there such a thing as over-diversification? Do you dilute your returns by diversifying? Is the S&P 500 enough? In today's video, I'll try to answer these questions and much more. I want to preface, first of all, by saying that there aren't rules. Finance is one of those fields where there's a shortage of things we truly know, but we do know diversification helps reduce risk and normalize your returns, bringing them closer to market average. But the exact number of stocks or the minimum number of stocks that you should hold is really a personal matter and depends on how you stomach market volatility. There are many videos out there on the same topic, but today I'll try to bring some new perspectives and how I see things. Charlie Munger, for instance, held 3 stocks only, and Peter Lynch, the polar opposite, held over 1,400 stocks. But before we get into the good stuff, we need to understand why we should have some level of diversification in the first place. Risk refers to the chance of losing money on an investment. Broadly speaking, there are 2 types of risks that you have to know. Non-systematic risk, or a company-specific risk, and systematic risk, the risk associated with the unavoidable and inherent risk a given country or market has. So think recession, inflation, interest rate changes, natural disasters, and so on. Diversification helps you reduce company-specific risks. By investing in more than a single company, you ensure that if one of them fails or goes bankrupt or simply proves to be a bad investment, some of your money is safe being invested in other companies. It's like the old saying, don't put all of your eggs in the same basket. Simple. But diversification also does something else. Several studies have found that the more stocks you have in your portfolio, the smoother it will fluctuate because of its reduced standard deviation of returns. The closer your returns will be to the market average. A figure that is often thrown around is that a portfolio containing something between 8 to 20 stocks would be enough to obtain most of the benefits of diversification. This comes from a famous paper done by Evans and Archer in 1968, probably the most quoted study on risk and portfolio size. But the thing is, Evans and Archer had a bad definition of risk. I know, this is a big claim, right? But pay attention now because this is key. They measured risk as the dispersion of a portfolio return around the mean return of the portfolio itself. So what they did was neglect the risk associated with the probability that the mean return of this portfolio would be different from the return in the market. I know, sounds complicated, but bear with me. Another way to put this is that the risk from holding a single security rather than the market is not just to the variability in that single security's return, but it's also due to the uncertainty that the average return on that security will be. It's so funny, right? This study has been fundamental, and I feel like repeat a certain thing enough times and you'll come to believe it. How many times have you not heard that 20 stocks is enough, or even that more than 20 stocks is diversification? You're just diluting your returns. Given this caveat that I just shared with you of this study, several more recent studies suggest that much larger portfolios are needed to achieve the benefits of optimal diversification, which would be to reduce company-specific risk, reduce portfolio volatility, and reduce standard deviation from market average returns. Just to name a few studies to you. Elton and Gruber from 1977, they found that a 15-stock portfolio has 32% more risk. A 60-security portfolio has 20% more risk than a 100-stock portfolio, assuming risk as the chance that the portfolio's mean return will be different from the expected market return. Newbound and Poon from 1996, they show that an investor who wants to be within 20% of the average risk risk would need to hold more than 100 stocks. Statman on 2004 finds that the current optimal level of diversification, which is the point where marginal benefit is equal to marginal cost of diversification, exceeds 300 stocks. A lot. And finally, just to name the last one, Damian, Luton, and Racine published in 2006 in their paper Diversification in Portfolios of Individual Stocks, 100 stocks are not enough. Well, they say that 100 stocks are not enough. Okay, so clearly there's some evidence suggesting that you should own more than 20 stocks if you're to fully benefit from diversification. However, I know this generates a few questions. How can someone keep up with 40, 80, or even 100 stocks in their portfolio? What about that extraordinary return that some stocks can give you? Are they not diluted by owning so many stocks? There is no one-size-fits-all answer to these questions. First, the more stocks you hold, the less important each of them become. What I mean by that is that if you have 50% of your wealth in a single stock, you need to follow this company's every move, be in every earnings call, read all their SEC reports, any breaking news, even visit the company's offices, and so on. However, if that same stock represents only 0.5% of your assets, then it doesn't require the same level of energy to follow it, simply because there's much less at stake. It's also important to know that different companies require different levels of tracking. A more stable company, such as Coca-Cola, for instance, is unlikely to have any major breakthrough at any given point. On the other hand, Nvidia, a player within a very complex and competitive market, with new developments coming fresh off the oven every day, is a different beast. You would have to follow it differently. Now, about the second question on diluting returns, there's no way around it. In economics and in everything in life, fortune favors the bold. The bigger the risk, the biggest the potential upside. It all depends on how much risk you're willing to take. However, before you sell all your positions and hold only 4 because you're bold and want your fortunes, hear this. Most individual stocks, believe it or not, are not great. They're not even good. This study from 2018 found that 57% of US stocks had lifetime returns that were worse than treasury bills. They also said that the net gain for the US stock market over the past century is more or less explained by 4% of the stocks. This is the real reason that holding a big basket of stocks makes a lot of sense. It's not because you want to dilute the damage from your losers. Most of them will be losers. It's because you have to cast a wide enough net to find the winners. With that said, how could you diversify your portfolio then? Is it buying just any stock? No, pal. Here are a few things that you should consider. First, the macro allocation of your portfolio. How much you want to allocate amongst different asset classes. This can be stocks, ETFs, REITs, bonds, gold, and so on. The second thing you want to consider is the sector and the industry that you're exposing yourself. So ensure that you own stocks and assets exposed to a wide array of sectors, industries, and sub-industries. The US stock market has 11 sectors, 69 industries, and 158 sub-industries. So that shouldn't be difficult to do. Third, correlation. Correlation measures the relationship between two stocks and how their prices move relative to each other. It is expressed as a value between -1 and +1. +1 would be a perfect positive correlation. Stock prices, they move up or down in unison. This would mean that the stock chart of two different stocks would look exactly the same. 0 means no correlation, no consistent relationship between the two stocks. And -1, the perfect negative correlation, means that stocks move in opposite directions. So if one stock goes up 1%, the other goes down 1%. Correlation is important because it helps you diversify your portfolios effectively. It's one thing if you have 10 stocks across 10 different sectors, but if they're all from the banking industry, I'm sorry to break it to you, but that's not diversified. Companies that are within the same sector and industry, or that rely heavily on certain macroeconomic conditions, will have higher correlation. So 10 stocks from the banking industry will have a high correlation, as you can see in the stock charts of these companies. Diversification is most effective when assets have low correlation, i.e. they move independently. If a portfolio consists of stocks that all follow the same market trends, diversification does not significantly reduce risk. Fourth, risk profile, weighting, and rebalancing. Finally, you should also account for the risk of each asset. If a stock is riskier, you should have a smaller percentage of it in your portfolio. If it's a more solid and stable company, you can have a higher percentage on this stock. This is known as weighting, whereby you allocate different weights to different types of stocks depending on their risk profile. An example of this would be Tesla, a growth and extremely volatile stock. Since January 1st of 2010, Tesla's stock has declined by 30% within a 30-day period 10 times. That's super volatile. Tesla in this portfolio would have a smaller percentage if compared to a less risky business such as Coca-Cola. You can do this by assigning different weights to each stock. As time passes, though, to ensure that your portfolio remains diversified, you need to rebalance it periodically to maintain your target allocations. If you don't, some companies may increase in value, thus increasing your exposure to it and your company-specific risk over time. Rebalancing ensures that risk exposure stays aligned with your personal risk tolerance and market conditions. Also, and this is personal, I would not recommend any single stock to represent more than 5% of your portfolio. Now, bonus tip. When building your ETF portfolio, something very few people account for is the level of overlap they have amongst them. For example, did you know that 84% of the ETF QQQ holding are also within SPY? You may believe you're diversified, but it may just be the case that you own several ETFs with very similar holdings. To prevent that, I present to you this free tool I've been using for years. The ETF Research Center has a fund overlap tool that gives you a very detailed information of the overlap of whichever ETF you want. I put the link down in the description below. Now, the last question. Is the S&P 500 enough? I often hear people complain that the S&P is too concentrated. Okay, the top 3 companies, they do make up almost 19% of the value of the US stock market, and concentration in the market is the highest that it's been in 92 years. But the market was more concentrated back in 1900, believe it or not. Back then, it was 63% railroads. However, the US stock market looks less concentrated when you compare it to other markets. In France, for example, 3 stocks are 23% of the market. In Germany, 36%. In Korea, 40%. In Taiwan, 59%. In fact, among the world's dozen largest markets, the US is the 3rd least concentrated. So, what's my grand conclusion? Forget about the 8 to 20 stocks portfolio. You're only increasing your company-specific risk without reaping the full benefits of diversification. The goal of diversification isn't just avoiding losses, it's capturing the winners. A well-diversified portfolio increases the chances of holding those winners. That is, unless you're the new Charlie Munger. Ciao. Good stuff.